Good morning and welcome to Business Morning. It's the last one for the week. Thank you for joining us. I'm Chimeze Obi Iwago. Nigeria has 34 mortgage banks, 27 commercial banks, and 7 microfinance banks that provide financing for housing demand and supply. But this structure is still unable to fully satisfy the housing needs of the people, leaving a deficit in the range of 17 million, according to a record of the Federal Mortgage Board of Nigeria. Our Lagos State, the commercial capital, is with a housing deficit of about 2.5 million units, according to the United Nations Special Rapporteur on Housing. So the state government is looking to woo more private sector investors into the real estate sector to handle this challenge. Let's watch this.
Lagos State, the commercial capital of the country, attracts a huge number of Nigerians. Records show that over 20 million people from all over the world live and do business in the state. This obviously puts pressure on the existing infrastructure, housing included. Criminally minded individuals have taken advantage of this need to defraud intending homeowners and investors. And so the government's call for investors into the sector may not be receiving the much desired response. Investors say a number of factors may be responsible for this.
Regulation is key. For instance, let government have the will, the political will, to ensure that anybody trying to do real estate business in Nigeria, well, in Lagos State, should at least register with government, and government should show sincerity, and they should start from their own Ministry of Housing, LSDPC, LBIC. Anybody that wants to do any transaction with government, they must demand for their certificate of registration with Lagos State.
There's need for that synergy between the government and the private developers, whereby we need ourselves for this growth. A situation whereby all those are tied to perfection. You see some tax rebate and some, how do I call it, that partnership, joint partnership. It's all needed between the private sector and the government.
Building that synergy is what the special advisor to the governor on housing says she is for. Heading the Lagos State Real Estate Regulatory Authority, Lasrera, she says collaborating with the private sector begins with collating of data.
Without data, we cannot give you physical planning. Without data, we cannot build roads. We cannot provide housing for you. If we do not have data of what is being done in the industry, who are the players in the industry, what is available in the marketplace in the industry, meaning properties and everything that is available, then we will not be able to provide resources as a government. We don't just want to say we want to know who the brokers are. Yes, data is key. Data is the #1 force that we're driving, but we also need to make business opportunities available for our people.
More ideas from the private sector are what the state wants through the real estate marketplace. And the governor, Babajide Sanwo-Olu, promises that the challenges and fears of investors are being worked on.
We need to do a better job of fiscal planning. We need to do a better job of LAPCA. And we need to do a quicker turnaround in our lands department. We've been on this GIS solution for a while. It's a project that we are desirous to go live on. Once they kickstart, what it will mean is a one-stop shop. Not only will you be able to get, your governor's approval or your CFO quicker and faster, all of the documentation, even for subsequent transactions on it, will be, on your screen, and it can be easier and quicker to upload and be able to give you answers to all of the queries.
The state says that part of the electronic documentation system should be running by the first quarter of 2021.
Of course, we cannot talk about investing in real estate or in any other sector without getting the foreign exchange market right. Now, the Central Bank of Nigeria, through a rush of circulars last week, intensified its efforts to address money supply growth, rising inflation and forex scarcity. One of the measures is the new guidelines on diaspora and other remittances, which will allow beneficiaries to receive their inflows in foreign currency. This is expected to encourage inward remittances and increase forex supply. Increasing forex liquidity is set to be the much-needed boost to avert currency volatility and strengthen the naira against a basket of other currencies, particularly the US dollar. Well, the Director General, Lagos Chamber of Commerce and Industry, Dr. Muda Yusuf, is here to give us his perspective to this policy. Thank you very much, Dr. Yusuf, for joining us on the program. Well, I'm sure you were watching that report on the need, Lagos State trying to bring in investors into the real estate. And just like I said in my intro there, you cannot talk about investment without addressing the issues of foreign exchange market, and here the central bank is trying to do that. So what's your take on this diaspora remittance policy that has just been?
Yeah, thank you very much. First, on the very important point you made about inspiring the confidence of investors, because no country is an island. We have to do business with other countries. We have to import, we have to export. And to that extent, and even when we talk about economic recovery, economic growth, expanding the GDP, it is very important to get that channel right. If you don't get it right, it creates a lot of distortions, and it creates a lot of problems for investors. Now we are talking about real estate. Of course, there's a huge gap in terms of deficit in housing, in real estate. And for that deficit to be filled, you don't have enough domestic capital to fill it. You need some kind of augmentation from foreign capital. Just as it is in real estate, you have such deficit in infrastructure and so many areas of the economy. And if there's any time we need such inflows, it is now. Not just for purposes of growing investment, but it's also for purposes of stabilizing the foreign exchange market. So coming back to the point you made about the circular on the diaspora remittances, I think it is something, it's a very good move. It's in line with what we have always advocated, which many commentators have also advocated, because the whole idea is to move the exchange rates and make it market reflective. That is the basic thing. And that is the thing that can bring some clarity, some certainty into that market. Because what is happening now is that because of the level of uncertainty, lack of clarity, there is so much volatility in the market. And more importantly, is the fact that we have so many players in the market who are in the market just to take advantage of premium. Premium between one window and the other. So we need a policy that will eliminate these parasites in the market. Because they are the one creating all the confusion, the speculation, and all of that. So what has happened to the diaspora remittance is a very good thing. And the whole principle is that whoever is bringing in this flow through this diaspora channel will have the opportunity, first, to lodge the money in his or her domiciliary account, or to sell the dollar at whatever the market rate is, within the framework of willing buyer, willing seller. So that is good, but that is not the only channel. Okay. We have other channels through which these inflows can come. So our position is that we should extend this policy to other channels so that we can improve liquidity in the foreign exchange market.
Now, when you talk about other channels,
yes.
Now, what other channels are you advocating?
Now, first, we have the export proceeds. I can tell you a lot of exporters are complaining a lot about the current exchange policy around exports. It's a major problem. If there's any time we need to encourage the exporters, this is the time. Because we need people to export and bring in foreign exchange. We should not put a policy in place that will discourage them. And what am I saying? The policy that is currently in place is that when they get their export proceeds, they lodge it and this exchange at about 386 naira.
That's very discouraging.
It's very discouraging for a country that is desirous of growing the non-oil exports.
So why can't they extend that to, this policy to exporters?
Of course, that is what we are hoping and praying for. And we are hoping that the CBN will do that. Because now there has been a whole lot of confusion around NXP. NXP is non-export proceeds form. Because when there is a problem with policy, when there is a problem with the quality of policy, there will always be a challenge with compliance. When there is a challenge with compliance, then you dissipate a whole lot of energy trying to enforce that regulation. That is what is happening with the NXP. In the last 2 months, if you know what exporters have gone through on issue of compliance with NXP at the ports, some of them have been at the ports for 2 months. Some of them with cargo that are perishable. Just because you are trying to enforce the NXP. And in the process, some of the export cargo had gone bad. I haven't got a report of 1 or 2 containers that has to be returned. Because by the time you sort out all these problems with the shipping companies, with the CBN and all of that, by the time you now onboard the cargo, by the time the cargo gets there, the cargo has gone bad. And those that had not completely gone bad, most of those cargo had deteriorated in value. Just because of these complications that this exchange rate policy has brought on the exporters. So the point we are making is that the policy that the CBN has put in place for the diaspora remittances should be extended to export proceeds. So that whatever proceeds they get, first, they should have unfettered access to it. If they want to lodge it in their domiciliary account, they should be allowed to do so. If they want to sell it at a market-reflective rate on a willing buyer, willing seller basis, that should be. And that will go a long way to help the liquidity in the foreign exchange market.
Aside from the export proceeds, what other?
Well, we also have we have the capital importation. If you look at the capital importation data, the thing has been declining. And why will you bring in your capital into a country where the rate you get for the importation of the capital is far less than what is perceived to be the market rate? So we have people who are, in the FDI window who want to bring in foreign exchange. We have the foreign portfolio investors who want to bring in foreign exchange. If they are allowed to bring it in at a market-reflective rate, it will boost liquidity in the foreign exchange market. We should not impose rates on them. We should allow the market to play. Initially, we may have issues of the exchange rate depreciating, but with time, it will stabilize and improve. Look at the impact that even this diaspora remittance circular has had. Before the circular came out, exchange rate was already going to the threshold of almost 500. But with the relaxation and the liberalization of that window, it brought some calmness to the market.
So you think if these other segments should be added to this, perhaps we could see the Naira strengthening
There will
further?
be a lot of improvements, a lot. Because the whole idea here is not to just be focusing on only oil. There are other, if diaspora remittances can fetch us over $20 billion annually, that is a lot. The FDIs or the portfolio flows too can bring in quite a lot. They can give us close to $1 billion monthly. Then we have things like even some of the government agencies. We have the IOCs, the oil companies. They also earn a lot of dollars. But we need to encourage them to drop the dollars in this market. If you continue to impose a rate that is not reflective of the market, they will not drop it.
Now,
and if they are dropping it, they will not drop it sufficiently enough.
There was this issue of dollarization.
Yes.
You remember that was why they said, okay, if you get in this dollar, you have to take it in Naira just to avoid this dollarization. Do you think, because I think that was the reason they stopped it in the first place. So that didn't quite help. And do you see this also bringing about this issue of dollarization of the economy?
No, certainly not. What we are dealing with here is the exchange rate management question. It's not dollarization. We need the dollars, and we need them to come in. That is the strength of an economy. When you are able to attract foreign capital into your system, it helps to boost the growth and the GDP. What we are saying is that we should have policies in place to ensure that we encourage those who want to bring in the dollar, legitimately, of course, I'm not talking of money laundering and all of these things. Of course, there are safeguards for that. But we should encourage them to bring it in and exchange it. It's not dollarization. Dollarization is if you continue to now engage in transactions in dollars. And it is, some of these problems can also even lead to that.
Yeah, that's
if the pricing of the currency is not right, you could push people to say, okay, because this naira is not, we can't rely on it, then we have to do our transactions in dollar.
Okay.
So allowing a market reflective rate will reduce the risk of dollarization that you talk about.
Okay, let's look at the issue of inflation rate. We've seen that skyrocketing, and financial derivatives think tank now is projecting even a higher inflation rate before the year ends. Do you see this policy helping to tame inflation, particularly imported inflation?
It will help, because this economy is highly exchange rate sensitive. We are highly import dependent, unfortunately. And that's a function of our production capacity. It's a function of a whole lot of things. But if you allow the expansion of the scope of market reflective exchange rate policy, it's going to calm down the market. It's going to reduce some of these volatilities that we are seeing in the exchange rate. It's going to, make it possible to remove all these parasites that are in the market because of the premium, all these rent seekers. They are all over the place. And this policy is breeding a lot more of them. And it's creating a lot of distortions in the foreign exchange market. So if we do that, it will help to bring down, strengthen the currency. If the currency is strengthened, of course, it will impact positively on inflation.
And so how...
we're likely to see a reduction in prices because some of these imports and things like that, their prices will go down a lot more.
So, I mean, let's talk about the AFCFTA.
Yeah.
Of course, that is taking effect January 1.
Yeah.
Now, looking at this policy, and if we have to have the naira falling, how is that going to be a boost for Nigeria to actually take advantage of this deal?
You see, in the literature, economic literature, when your currency is weak, it gives you an advantage in the international market. Because whatever you produce, unfortunately, we are not producing much. But whatever you produce will be very competitive internationally. That is the more reason I'm worried about the exchange rate policy around the export sector. This is a very good advantage for them. By the time we have the AFCTA, apart from the structural problems that we have that may impede productivity, production, real sector competitiveness, and all that, ordinarily, it's a big advantage for us. It will be easy for us to overrun quite a number of countries as far as whatever is produced here or whatever things we have here is concerned. Because the exchange rate is weak. And there are even some countries, particularly in the Asian area, that deliberately weaken their currency in order to be able to boost their exports. And it has really helped their economies. Although the argument can be that, well, we don't have much to export, but we have to begin from somewhere to encourage those who are already in the export. So if you have that within the concept of this AFCTA, I think it will help. And for us to also play very well in the concept of the African Continental Free Trade Area, we also have to get proper alignment of our exchange rates. If you continue to have this confusion, it's going to create problems for us within the African Continental Free Trade Area, because we are not talking about international trade. And the beauty of international trade is for you to have seamless transaction, currency-wise. That is important. We need to get it right in order to get good value from the African Continental Free Trade Area.
Well, I guess it's about one step at a time.
Yeah.
Hopefully, the central bank will, of course, consider these other sectors. And I'm sure it's a case of monitoring, okay, how has this one worked out and all that. And you are an advocacy person, so you continue to advocate and continue to have words with the policy authorities.
We have to.
It's always a pleasure to have you on the program, Dr. Yusuf.
It's a pleasure.
Thank you. And enjoy your weekend.
Thank you.
And what is the market's perspective to the trade deficit? How is the central bank's introduction of special bills playing out in the markets. The chief economist and head of research at Greenwich Merchant Bank, Ayodeji Ebo, joins us next. To stay with us. All right, before we talk to Ayo, let's take a peep into the global oil market. Prices rose around 1% this morning, extending a sharp rally overnight that saw Brent rise above $50 for the first time since March, as coronavirus vaccination rollouts kept hopes alive that demand for crude will build up next year. Brent was up 45 cents at $50.70 a barrel after gaining nearly 3% on Thursday. U.S. oil was up 50 cents to $47.28 a barrel, having also risen almost 3% in the previous session. That leaves prices set for a sixth consecutive week of gains as promising vaccine trials helped quell gloom over record increases in the number of new infections and deaths around the world in the coronavirus pandemic. Britain began inoculations this week, and the United States could start vaccinations as early as the coming weekend, while Canada on Wednesday approved its first vaccine with initial shots due from next week. A big jump in U.S. crude stockpiles served as a reminder that there is still plenty of supply available, but ignored as bulls run through the market this week. They were encouraged by signs that Asian demand is strong, with India's biggest refiner saying that it was operating at 100% capacity of all its 9 units for the first time since early this year. All right, let's talk to Ayo. Thank you, Ayo, for joining us again today. Well, the latest foreign trade data reveals that Nigeria's trade deficit hit a record-setting gap of about 2.3 trillion naira. And many believe the CBN's new policy on diaspora remittances can help to address this. I mean, I just spoke with the Director General of Lagos Chamber of Commerce, and he has also called that CBN, the central bank, should extend this policy to even exporters, to foreign direct investors and portfolio investors. From an investment analyst point of view, what are your thoughts on this?
Okay, thank you. I'm sure that CBN would also come up with policy within the to increase liquidity within the FX market in relation to the export segments, like what we saw within the diaspora remittances. I think part of what CBN would have also looked at is looking at where bulk of the FX comes from. If you look at based on data, you discover that over $20 million on an annual basis has been coming in from remittances from Nigeria in diaspora. So I think it's the bulk of that fund that the CBN is also trying to target. So
okay, yeah, are you still talking?
Hello? Okay. Yes, I can hear you now. Yeah, so by and large, the CBN is trying to look at, for their whole angle on how liquidity can be, FX liquidity can be increased by not depending solely on oil proceeds. But as it relates to bridging the trade deficit, when you look at the import data, or the trade data rather, you would also discover that the major segment that was responsible for that decline was the exports, because the production cuts that from OPEC Plus affected our production, and that impacted on what we're able to export. So, and that we feel that will also will continue to impact on the exports even in Q4 and in Q1, pending when we see a major increase in the amount of production that Nigeria can contribute to the global oil production.
Okay, with the OPEC Plus quota on oil production levels, what are the sectors or commodities present opportunities to narrow the deficit gap? And of course, we have seen oil price rising above $50 per barrel. What would that mean for us in this regard?
Okay, made a very valid question. When we look at the trade data, you discover that the manufacturing sector still accounts for less than 5%, which is the area where we need to focus more on. And looking at the manufacturing sector, they account for, the SMEs account for over 60 or 70% of the industry within that space. So if we need to come up with very deliberate policy or incentives to drive the manufacturing sector, you cannot dissociate. If you want to grow our economy, need to see how we begin to add value to our raw materials, and that is what can grow the manufacturing sector. We pick some of the major sectors. For instance, we've been talking about how much of value add after we have harvest. That's also a major area which would also solve our unemployment problem and will solve our FX challenges, and we would stop depending on oil. So when there's any major volatility on oil prices, it impacts on the performance of the economy. So it's critical to come up with incentives to support the SMEs within that space so that we continue to add value for what is available in Nigeria. So we don't just export raw materials and we import the finished goods. It means that we're actually creating employment for other people in other countries and at the expense of Nigerians.
So what's your outlook on trade relative to other African countries, especially with the commencement of the AfCFTA deal?
Yeah, it's interesting. The AfCFTA will be kicking off in January, and I'm not sure Nigeria is ready to also to take advantage of that. We need to first review this the land border, which is also critical to the performance of how we're able to benefit from the after. And I spoke earlier about the manufacturing sector. This new agreement favors more of the manufacturing sector because they will be able to export their goods across African countries. Yes, we have that challenge of the quality of some of the things we produce for some of them. But now within the African countries, we would be able to access more market that may not be as sophisticated as the developed market that we export. So this is an opportunity where we need to exploit. Transportation would also be very critical for us to be able to take advantage of that, linking some of these African countries. So I believe that yes, the AfCFTA agreement is a positive one for Nigeria, but we need be able to reposition and support our companies for them to be able to manufacture at a competitive price, and they also be able to export.
Now let's touch on the equities markets, which had a swell time in the month of November, a stellar gain of 14.78%. However, there seems to be some kind of reversal of that upbeat mood in December. What are you alluding this change to?
Okay. Yeah, for the equities market, looking at it from December, it started with some profit taking. And I think last week, the CBN also issued a circular around the special bill, which created some form of what I would say a suspense in the market. So for the fixed income market, we know there's a negative relationship between the fixed income market and the equities market. And so for most of the players, the market players were expecting to at least be able to affirm what levels the CBN will issue the special bills. As a result of that, we saw for some investors trying to take profit ahead or reduce their exposure. But what we saw as at yesterday, the special bill was issued, I think is estimated at over 4 trillion at 0.5%. And we also saw the PMA result on Wednesday, and surprisingly, we saw the one-year bill close above 3%. So that also threw some panic into the fixed income market. And as a result, there was expectation that yields would improve. And if yields begin to improve within the fixed income market, it will begin to compete with the anticipated dividend yield within the equities market. So we saw that shock yesterday, especially the banking sector lost about 4%. But as our trading this morning, we've seen some of those stocks are already firming up. Investors are new investors are trying to take position and trying to buy some of these stocks at better prices. So we feel that we don't expect this downward trend to persist. Some of the stocks now present better opportunities ahead. Full year dividend that will be declared in the first quarter of 2021.
Now, until this week, we got a sense the CBN was looking to keep rates at low levels, although with twin issuance of the PMA for Treasury bills and the newly issued special bills at 0.50% that you talked about, are we likely to see a reversal in the restrictions of the OMO participants?
Well, we don't expect for now for CBN to reverse that policy around the participation of retail investors and especially domestic investors in the OMO market. The focus now with the issuance of the special bills yesterday, the 81-day bill at 0.5%, that created some form of clarity in the market, though there's still a lot of questions to be answered around how those bills will also be traded. But we feel that market has begun to take so has begun to settle, and we believe that rates has improved. Yesterday, rates improved an average about 100 basis points across the FGM bonds market, and we'll begin to see some demand. We saw that towards the end of the market yesterday, we're also seeing demand. So based on our view, we feel that interest rate will still inch up slightly, but because of the expected liquidity in the system, that's the downside risk that will keep them at check.
Now, do you think these special bills will be a game changer for the fixed income market? What trends are we likely to see in the mid to long term?
Yeah, for the special bill issued by the CBN, we expect that it will impact on the shorter end of the curve that has been trading at almost 0%. So rates is expected to improve within that segment. And with the tradability, so depending on the tradability, a lot of traders are still also trying to find out the modalities of how these bills will be traded. Until we get that clarity, I won't to say much regarding how much of impact the bills would have across the fixed income market.
All right, thank you very much, Ayodeji Ebo. It's always a pleasure having you on the program. Be safe. Thank you.
Thank you for having me.
Well, Eddie, I'm throwing the ball to you. Yesterday wasn't good for investors like us.
You're right, it wasn't good.
I don't know, the bear took charge. But however, I'm sure you listened to Ayodeji Ebo explaining what perhaps happened at that market yesterday, kind of a competition between the rising yield in the fixed income market and, of course, the expected dividend payout at the equities market. I wonder how long we're going to see that, although he's saying that as at this morning, even new investors are beginning to take advantage of some of those penny stocks there.
And it's expected because, you know, the market has been down for some time now and a lot of the stock prices have been low. So this is actually the time for investors to take position. You know, they would always say buy low and sell high. So now that prices have gone down, investors have taken advantage of this. And, you know, yesterday's declines were, like Ayodeji said, were largely due to the banking sector. We saw losses from the tier 1 banks. FBN Holdings was down by about 10%. Access Bank, GT Bank, UBA, and Zenith Bank, they were all down yesterday. So, of course, that dragged the market. The all-share index was down 1.27% to 34,577.26 points. While the equity cap was at 18.072 trillion, I'd just also like to point out that we've dropped to the 34,000 psychological level. However, activity level was high yesterday. Volume increased by about 95%. Value was higher by about 85%. And we saw 6,441 deals. But let's talk to Afolabi Benro, a trader at Stanbic IBTC Stockbrokers. Good morning, Afolabi. Thank you for joining us on the program. Good morning. Thank you for having me. Now, we've seen, you know, yields, rather, I beg your pardon, the stocks and the market decline this whole week. Now, this year has been different from other years. Should we really be expecting a Santa rally this Christmas?
I wouldn't rule it out completely. I mean, prices have been depressed for a while, and, you know, valuations are still good. And I still believe that, you know, there's a dividend yield play that investors are looking at. And, of course, as the prices are dropping, they're locking in a better dividend yield. So I believe that, you know, it's possible that we'll start to see investors take positions, you know, ahead of the expectations of the dividend payouts next year.
Now, we've seen a couple of earnings forecasts come into the market. Now, this is the last quarter, and, you know, by next year, January, we'll be expecting Q4 earnings. With what we've seen from the performance of companies in the third quarter, what are your expectations for Q4 numbers? I mean, you could look at it by sectors, the banking sector, the consumer goods and industrial goods sector.
Yeah, I mean, we don't really expect so much of a deviation from what we've seen for Q4 in Q3. The last quarter is usually, you know, a quiet quarter because, you know, a lot of guys are sort of rounding up, you know, for the year. So, I mean, in terms of the expectations, we don't see too much of a deviation from what we've seen in the third quarter.
This week, you know, unless there's a miracle today, this week is most likely going to end negative. But what is your outlook for next week?
I still think that we'll see bearish sentiments in the market, especially in the beginning of next week. The market is up slightly this morning, about 14 basis points, you know, but things can still change. Buyers are still being a bit cautious, you know, because of the way the market has been dropping. So we've seen buyers sort of pull back. Guys that were at a certain level as the market was dropping, you know, because they want to get, you know, the best return, they will pull back, you know, a bit more. So I still expect that, you know, that we'll continue to see maybe some bearish sentiments. And we have to also remember that, you know, the year is rounding up, and a lot of investors are trying to sort of like book profits for the year. So I wouldn't be surprised if we see that continue going into the end of the year.
All right, Afolabi, thank you for your input on the program. Afolabi Benro is a trader at Stanbic IBTC Stockbrokers. Well, Chimi, just before we go on a break from the equities market, so the banking sector contributed a large chunk of the volume that we've seen traded here. As you can look at it, all the sectors were down. FBN Holdings was down about 10%. Access Bank lost about 6%. GT Bank was down about over 2%. Zenith Bank was down 6.18%, while UBA was down 3.66%. So we hope that, you know, trading today, I mean, we've already heard that the market is up. So we hope that, you know, these positive sentiments that have started today will fall through to the end of the trading day.
Well, a lot of analysts you've been talking to, well, Ayo said it, Afolabi also said it. I share the same optimism with them. Santa will come. Eddie, we'll take a break. And when we come back, of course, we'll talk to Juliana before I come back to you. And for London Market Report, let's talk to Juliana. Hello, Juliana. Good morning. Well, Prime Minister Boris Johnson has sounded a note of warning of strong possibility the UK will not reach a post-Brexit trade deal with the EU even before the Sunday meeting. What sound bites are you getting out of London on this?
Well, it's not great. Yesterday evening on Twitter, #resign was trending in the UK, and that's really because the British public are furious at Prime Minister Boris Johnson's pretty dark tone that he put out yesterday evening. It was the first time we had heard him speak since that 3-hour-long dinner in Brussels with Ursula von der Leyen. And basically what he said is the British public must prepare for a no-deal Brexit, and whether or not a deal can be reached over the next 3 weeks with the European Union, things will change. He did brief his top cabinet ministers yesterday evening, telling them to prepare at all costs for a no-deal. We've been discussing it extensively over the past couple of months, Chimmy, and there is still some really pretty strong outstanding issues, one of them being fisheries. Who knew that fish would be a topic of much concern between Brussels and Westminster? But Prime Minister Boris Johnson and his cabinet ministers that have been speaking on British television this morning are saying no Prime Minister or President or head of state in the world would allow another nation or another trading bloc to have unlimited, unfettered access to their fishing waters. It's their territory. They don't like it. I believe with the European Union side, one of their main sticking points is governance and level playing field. They do not want British companies to be given a one-upmanship over European companies, and also who is going to govern this new arrangement. So it's not looking great. Of course, they have given a deadline of Sunday. We're expecting this weekend to be the final make or break decision. There is an EU Council summit. I believe it started yesterday. It's still continuing today. Sources close to the matter did suggest at first that Brexit negotiations would be a topic of a big discussion there. That's not the case. I believe the rest of the EU 27 are pretty ticked off that Brexit talks seem to have dominated other more serious matters, no less than the COVID recovery. And that really has been led by French Prime Minister Emmanuel Macron, who is not really happy. And, the love-hate relationship between Britain and France is really showing. But, there are still 3 weeks left. Boris Johnson, in his address yesterday, did say that he's willing to go to Paris. He is willing to go to Berlin. He is willing to take it to the final line. But it does appear that it is very, very, very likely that Britain will be crashing out of the EU in Australian-style terms. And Australian-style terms basically means no deal, no trade arrangement. We're just going to go back to WTO very quickly before we move on. The Office for Budget Responsibility has predicted that if we do crash out in the next couple of weeks with no deal, then that is going to wipe off 2% of GDP, which is the equivalent to about £45 billion. Let's not forget that the UK economy is already about 10% lower than it was pre-pandemic levels. We are going to suffer more acutely than any other Western nation. So it's not good. It's not great. Boris Johnson went into the year saying that he had an oven-ready deal, that it would be a failure of statecraftship if he doesn't get a deal. But he has told the British public and he has told his cabinet ministers to prepare for a no-deal Brexit.
Not only that, even the industry leaders have warned that business travellers will face fines of up to £20,000 if they do not apply for special permits for visits to conferences or exhibitions in the European Union if there is no Brexit deal for the service industry. What are you learning about this?
Well, this is just one of a 1,000 issues that have been discussed over the past 4.5, nearly 5 years. It's not just business travellers. It's the lorries, it's Dover, it's food, it's travel. There are so many different issues to play for. And one of the topics of concern for British businesses and anybody that wants to travel or do work in the EU is what happens next, because it's been pushed to the wire. ministers have been unable to really provide as much information as they possibly can to individuals. Yesterday, there were some pictures taken, some pretty public pictures taken at the Eurostar. Two very senior French ministers were dealing with customs at Eurostar. A lot of people in Britain did feel as if Emmanuel Macron was showing some sort of intent to Boris Johnson, showing that he is willing for a no deal. But you can imagine, you know, a lot of British people were able to just jump on a Eurostar, go about their business, travel to anywhere in Europe that they wanted to without fear of a visa or any fines. That's not going to be the case anymore, even if we are able to strike a deal by Sunday. And I think going back to the story that you were talking about, which was reported in The Guardian, in a non-negotiated set of circumstances, and then, of course, if you try and do some business within the EU and you haven't followed the rules and the regulations, you could be fined, and those fines can cost up to €20,000. So that's a concern for businesses. We are expecting to hear possibly today from the Duchy of Lancaster. This is Michael Gove, a very senior cabinet minister who is in charge of a no-deal Brexit. But this is very late in the day. A lot of time, a lot of effort, of course, quite rightly, has been put towards this COVID recovery. But now ministers are scrambling, trying to get some measures in place for passengers who wish to travel on January the 31st. Forget the EU 27. There are about 30 other countries that Britain need to negotiate some sort of visa, travel and business permits to. So, yes, it's very hectic here at the moment, and cabinet ministers are very, very busy trying to negotiate these complicated issues.
Well, Juliana, aside from Brexit, I'm sure you have quite a lot to update us on. And Bank of England, of course, saying that it's lifting a temporary ban on shareholders' payouts. Perhaps you have to give us the update on this when you talk to BC later today. We have to come back to the studio with Eddie for the debt and currency market update. Eddie.
Thank you, Timmy. Well, the bond market has been bearish, though, for 4 consecutive trading sessions. And just like Ayodeji mentioned, yields on that segment of the market rose by about 100 basis points yesterday. We had 5 deals worth 1.50 billion naira. But to talk more about the market is Dumebi Udegbunam, a fixed income trader at UBA. Good morning, Dumebi. Thank you for joining us on the program.
Hi, Vivian. Thanks for having me.
Well, yields on the much-awaited CBN special bills have now been set. And yesterday we saw that the Nigerian Treasury bills market was flat. Also, the OMO market was flat. Why did that happen? And how do you see these special bills affecting or impacting trading at those 2 segments of the market?
Okay, hi, thank you. So basically what you saw happen yesterday and on Thursday were very discautious trading, actually. As earlier mentioned on this program, special bills coming into the market might be as high as $1 trillion, which might more or less affect system liquidity. So we see a lot of market participants selling on the back of that information. And also, we also had an OMO auction yesterday and an MTB auction the previous day. On the OMO auction, about 70 billion was sold, while in the MTB auction, about 50 billion was sold. So all these activities more or less cause cautious trading in the market, and also on the back of the special bill that is being offered, which is a return of about $1 trillion that might hit the market. So all this spurred very sentiment and also cautious trading will lead to a bit of apathy in the market.
All right, Dumebi, thank you for your input on the program. Dumebi Udegbunam is a fixed income trader at UBA. Well, Timmy, that is on the market review for this week. I'm positive, and I know you are also optimistic that the equities market will definitely be ending
Always, not just the equities, even the fixed income market. I mean, you invest to make profit. So all we ask is profitable trading day for everyone. Thank you, Eddie. And that's a wrap on the program. Thank you for watching. I'm Chimeze Obi Iwago. See you again next week.